thank you very much. It is a pleasure to be here and see so many people. And from doing some chats earlier on, I appreciate not everyone knows what Moray International is, so I will begin with a description of the trust. So this is a large, global investment company traded on the London Stock Exchange. I'm one of 2 fund managers who manage the trust. And I've been involved with it for over 20 years, as has my colleagues. So obviously we like it. We're very pleased to be associated with this product. We start off every single presentation with a reminder or just telling you the facts. What is our investment objective? And this doesn't change no matter what's going on in the wider world. So the investment objective is pretty simple. We aim to deliver an above average dividend yield compared to our peer group. We aim to have growth in those dividends and growth in capital ahead of inflation over time. And the track record of doing that has been pretty decent over time. Just last year, we hit the 20 years of dividend growth status. A couple of years before that were flat, so it's not that we've had even cuts before that time period, but 20 years of consistent dividend growth. The level of yield has been above peers for a long time. 4.5% roughly is where it's been over that time period. And we have delivered the dividend growth above inflation and the capital above inflation more years than not over the past 20 years. So the dividend growth, for example, has been 7% on average over that 20-year time period. And it's interesting to see what the total returns have been over the last 20 years. So we have a total return figure of 10% in sterling per annum over that 20-year time period. So roughly half of that coming from income and half of it coming from capital growth. Now that's slightly ahead of a typical global equity index, but the composition is very different. So that greater proportion from income is a standout feature, and it's very different in terms of when you would expect this trust to do well. So typically we do participate in upside, but if you have other more growthy stocks blowing the lights out, we are not likely to keep up with that in any given year. But the flip side of that is that there is an element of downside protection. And one reason for that is that we try to cover the dividends. So any income that we pay out to our shareholders is generated from the income derived from the underlying position. So that naturally takes you into a bit more healthcare exposure, a bit more staples exposure over time to give you that more consistency of income. Now, a great thing we have is reserves. So one of the key features of investment companies as a whole is that you can, in bumper years for dividends, put some away for a rainy day, and it's there to dip into when you do come across a storm like COVID, where a lot of our underlying holdings just stopped paying dividends totally. They were told to, they were mandated to. But it meant that because we have reserves there, we have around 1 year's full worth of income, 74 million it was at the end of last year. So it means that you can support that consistent dividend message to your shareholders. So that has gone down very well over the years. The trust is truly global. It is as diverse as it's ever been. So if you look at, first of all, the regional allocation, we're invested in lots and lots of different countries. So we have 22 different countries there as represented by the country of listing. And it's pretty well balanced. So you'll see, for example, we have around a quarter of the trust in European companies. We have 30-odd% in North American companies. Actually, Canada's 5% of that, so about 27% in the US. We have a significant exposure to Asia, 20-odd%, and we have a relatively small weight to the UK. So at one time, this was huge. This had to be like 40% going back 20 years in order to deliver the investment mandate, in order to generate income, but that's no longer the case. So that UK weighting is pretty small. It's not that we're anti the UK. We have some good companies there, but we just have so much choice now. We do have exposure to Latin America, which is, again, a bit of a differentiator. People can assume that Latin America is trouble and it's volatile, and why would you bother? Look at what the currencies do. But actually, that's been the strongest component of our trust over the past 20 years. So it's only about 7% currently. It has been higher in the past. But that has delivered annualized returns of 17% in sterling terms over the past 20 years. So if you pick the stocks right, then it can be valuable. And we have analysts all over the world. So we do have a team in Sao Paulo, for example, who cover that part of the market. So it's great to have that flexibility. These weights do change. It's all to do with the stocks, but they do change over time. So for example, that European weight has doubled in the past 5 years, and we saw opportunity there at the stock level when the Russian invasion of Ukraine happened. And that's when a lot of European companies were very out of favor, very unloved, but these were global businesses, things like Danone and Siemens, BE Semiconductor, that we thought were very solid businesses, were trading at that time at attractive valuations in our view. Something that also surprises people when you talk about income is the fact that you can be diverse from a sector perspective. So we do have an allocation to technology, for example, 15%. And it means that if you find income-paying companies within that particular sector, it just gives you something a bit different. So it was pleasing to see in the previous presentation, we've got some of those names. So we have Broadcom, we have TSMC, two of our biggest weightings. And the weightings do change over time. So for example, we bought Broadcom, a key beneficiary of AI, 3 years ago now. That was on a 7% dividend yield back then. And we bought it, it's now our lowest yielding position, so that's given us a bit of an issue. We've taken a lot of money out of the name because it has been so successful, but it's still a 4% position in the trust. Now, offsetting that, we do have the more traditionally income types of companies. So you'll see a significant allocation to things like healthcare, as I say, but lots of different businesses represented. This next slide is just giving you a feel for the kind of trading that we do in the funds. So I do think it's important for this type of strategy. We have our forecast at the start of the year for what we think each and every one of our companies is going to deliver from an income perspective, so we don't chop and change things too much. Typical turnover is around about that 13% level. It's not fixed by any means, but in terms of what we did last year, just by way of an example, there were 4 divestments in total last year for a range of different reasons. We sold out of Roche, one of our healthcare holdings. Nothing wrong with the business, but that industry has changed and it's continuing to evolve. So back when we first initiated Roche many, many years ago, this was the cancer specialist in the world. No one could really touch it. That's different nowadays. There's lots and lots of competition. And our healthcare team, which is based in Boston, they just preferred other names over Roche, and we have plenty of choice there. So that was a divestment last year. TC Energy is a Canadian company, one of 2 Canadian companies that we own. It's a pipeline operator, and the switch was from TC Energy into topping up Enbridge, a competitor. We quite like that within an energy context because it's not beholden to the energy price. It makes money regardless as it's transporting energy across North America. So that was an analyst preference. China Vanke is one we got wrong. So this is a Chinese property company that we bought with our eyes open, knowing that was going to be a tricky marketplace, but this was definitely one of the stronger players in that category. Strong balance sheets, good support from the government, etc. But so many years down the line, we gave up on this name because there hasn't been enough change there to benefit even one of the better companies in that sector, and it cut its dividends, so we sold out of that one. Epiroc, the final one I mentioned on the divestment side, is a sale for the right reasons. We got that right. This is a Swedish company. It does mining equipment, very asset light. It's more on the design side. So this one, the valuation rocketed and we got out of that one. So we're always, again, keeping an eye on valuation also. Top slices, you'll see tech names appearing there. We have a maximum of 5% in any one position. So it means that it forces you to be disciplined. It forces you to take profits rather than getting too carried away with any one individual name. So Broadcom and TSMC and Hon Hai Precision, which has been caught up in the AI story now, were part of those 5% cuts. Another one, an interesting one we think, is Grupo Asur. So not a household name by any means. This is a Mexican airport operator. It runs Cancun Airport in Mexico. This is one we've held since its IPO over 20 years ago. So we are patient if we think the story still holds. And this one has been through all. It's been through swine flu, it's been through COVID, it's still there, it's still doing well, and its cash flows are terrific. It's actually just announced a real bumper dividend for this year. So we're happy to hold it. Again, not to just let it go up and up forever, because nothing's perfect. So that one was a trim last year. And the other couple I mentioned there, Unilever and Danone, those were turnaround stories within staples that we still think have some legs in them, but they have done very well, these companies, in turning things around. So we recycled some of that capital into other names which have been weak. So Diageo was mentioned in one of the slides earlier. That's one we're sticking with. It's been a real dog. It's been a real hard one to hold on to in some regards. But the power of the brands, we think, will see this company through difficult times, and it does pay you a really nice income in the meantime. So that's one we're sticking with. Pernod's another one in the same category that we're sticking with. And then Walmart de Mexico is one that gave us a bit of trouble last year. This is a really well-run business. Its parent company is Walmart, but in a Mexican context, it's extremely strong. It has phenomenal returns. You would never think it's a retailer if you look at the balance sheet of this business. But to offer something different, it does get caught up in stories around things like Mexico at times, but to us, that's an opportunity to add a little bit. And then on the purchases side, Mercedes-Benz, another one that gets talked a lot about in shareholder meetings. We were too early with this, but we're sticking with it. The cash flows in this are important. So it's paying you just now about a 7% dividend yield. It's paid for the year. It's an annual payer, so that's locked in. Taylor Wimpey is something a bit different for us. This is the smallest company we own in the trust, so a minimum position is 1%, which means that a lot of the really small cap stuff's just not possible for a fund of this size. The fund is 1.8 billion. The Taylor Wimpey at about 5 billion sterling market cap is doable for us. It's the only UK domestic name we have, so again, something a bit different, about a 7% dividend yield. Great land bank, so we like the management team, we like all these aspects to it, and it is one of the biggest players in its sector. It's spread across the UK, which is also helpful. Coca-Cola, everyone knows it, that's a compounder, so it's not that we're thinking we have any massive insights in here, but unusually, it started to underperform at the tail end of last year when the likes of Unilever were going strong. So that was recycling some of that capital into what we think is still a very strong company at an attractive entry point. Similar dividend yield as well, about 3%. And then Medtronic is a company within healthcare, but it's not pharma. So a lot of the exposure we have is in pharma companies. This is a bit different. It's more medical equipment, etc. So it's all about the stocks, basically. I think people can sometimes think we have a view on markets, and we're aware of the backdrop. Our focus is predominantly on these businesses. Top 10 holdings will show you, again, the diversification of the trust and the fact that we can go into some of the lower yielders because we have really high yielders on the other side to generate the overall average of 4.5%. So lots of different businesses in there. This is a slide we put up. We don't need it so much nowadays, actually, with the US coming off, but for a long time, people would point to the, underweight, if you consider it to be that way versus any other index, and say, well, why don't you have more in the US? And this is why, because it's not a given that the US market is always going to outperform. We're much more interested in the companies. And then this really does tell a story. The numbers are tiny, so you won't see them, but this looks over the past 26 years or so, and looks at various different regional returns in sterling, so you're taking currency out of it, translating it all back into sterling, and looking at what has been the best performing market over time. And sadly, the UK has not even made that list once. We do have North America dominating a bit more recently. We've got some exposure to the UK, Japan, Asia Pacific, and then Latin America takes the top marks. It's been the best performing market for most of that time period, actually. So again, it's about keeping an open mind. This is truly international, and we make full use of that remit. And then just finally, this is a performance of the trust. Again, the numbers might be quite small here. You might not see them, but again, it emphasizes the point. This is not a closet, benchmark fund. This is something a bit different. The returns illustrate that. So in a year like 2020, you'd think we were superstars. The price was up 16%, market return was up 6%. And then you'll think, what the heck happened last year? That's a very different story. But the fact that it is different is something that we don't shy away from. There's plenty of options out there if you want a standard global equity exposure. This does give you that capital upside potential with some downside protection, and it gives you the income story on top of that. So we stick to this. This is what we do day in, day out. And I was delighted to get some questions earlier, so please do come and speak to us later if you're interested and want to find out more. Thank you very much.